All right, so let's go ahead and dive right into chapter 2. What is accounting? Okay. So yesterday we took a look at the definition of what accounting is. It is the process of collecting, recording, sorting, analyzing, interpreting. Ultimately, at the end of the day, we are trying to understand a business transaction, okay? And recording their events, okay? So as we mentioned yesterday as well, right? Here are a few things that we are looking into the areas of accounting, right? In this particular type of accounting, when we talk about recording and collecting resources and data, that is primarily for financial accounting, okay? We're not dealing with tax or managerial or forensics, but we are doing financial accounting, okay? We're also going to be taking a look at things that we should be taking note of because, like I've mentioned before, right? Accounting is essentially like learning a new language, right? In English, right, to receive something, we say a receivable, okay? To pay for something, they are usually expenses, okay? To owe something, they're payables, or also known as liabilities, okay? And of course, property is an asset, right? You own it. And of course, obligations are going to be liabilities, right? Because a liability, right, is considered debt, but we don't necessarily use debt in accounting like we do in English, right? In this case, when we have liabilities and we owe other people, it becomes an obligation that we must pay, okay? So in this case, to an obligation would be a liability, okay? So that's just very similar, or just in like a quick little brief introduction of a few accounting words that you will see here in this class, okay? So let's go ahead and dive into the very basics of accounting, which is going to start with the 5 account types. Now, what are accounts? Accounts are some kind of systematic way to keep your records organized by sorting out the data into sections, okay? All right, and these are the 5 accounts, no more, no less, okay? These are the 5 accounts that you're going to be utilizing when you see a business transaction. How do you organize it in a way that you are going to be understanding what the transaction is about? So again, you have your assets, liabilities, equity, right? And then you have your revenues and your expenses. There's 5 of them, okay? And here's what you need to know. Your assets, liabilities, and your equity are going to be your permanent accounts. These accounts never close out at a given end of an accounting period, okay? For example, right, a bank account. Your bank account is considered an asset, right? If you decide to randomly close out your bank account, right? What does that tell the world? That tells everybody that you're no longer doing business because you closed out your bank account. So that's a perfect example of why we would never close out our permanent accounts, okay? Same thing with a liability, right? If you owe somebody a loan, right? And you decided to close out that loan. So if you decided to close out that loan, you either paid it off or at the end of the day, you could file for bankruptcy. But at the end of the day, that liability, they're still going to come after you because they want you to pay it back. So there is no closing out a loan, okay? And then of course, we're going to talk about our income and our expenses. So revenues and income are synonymous, so they're interchangeable. You can use either or, but I like to use revenues. It's straightforward, but revenues and income usually are the same idea, and of course, your expenses are what you spend to operate your business. So in this case, these are your temporary accounts because they do close out at a given end of the accounting period. Okay, so I'll give you an example, right? Let's say you run your monthly statements, okay? You are measuring your revenues based on a month-to-month basis, okay? The main core and purpose of closing out your income and your revenues, your income and your expenses, is to have some kind of meaningful way to measure profitability, right? And the best way to do it is that, think about it. Your revenues, right, are your sales, right? If you sell a product to a customer, here is why this is such a perfect measurement, because revenues. Can you expect a customer to show up and order the same thing over and over and over and over again? In most cases, if you have a regular customer, of course you can. But sometimes, what if one day it's been months and that customer decides to come in and it says to you, I want something different? That's where your prediction of that sale has changed. And that's exactly why revenues needs to be closed out, because it's a perfect measurement. Because in this case, right, that one customer made a different order. But you have to also think about it this way in a real business aspect too. You're going to constantly get new customers. You're going to constantly lose your customers, okay? So in this case, right, that's how we can measure revenues, because we have unexpected and you can't predict your revenues. Same thing goes with your expenses, right? Expenses, right? You have what's called fixed expenses and then you have regular expenses, okay? Your fixed expenses are going to be things like your rent, where you constantly know it's going to be the same amount every single time, right? But one thing that fluctuates is going to be your utilities, right? Because maybe this month it was so hot, you turned on the AC, and now your electricity bill went up twice as much, okay? So think of it that way, right? You can never expect your expenses to be the same. So that's why when we talk about comparing our revenues and our expenses and closing them out at the end of the accounting period, right, it gives us a measure of some kind of measure that, how are we doing? Are we earning enough money to be able to cover everything that we spent? Okay, and that's the ultimate goal of closing out those temporary accounts, okay? But let's go ahead and further talk into details about each and every one and how we actually separate them, okay? So let's talk about this section here, where this is where we formulate our list of accounts, okay? You can refer it to your chart of accounts, or you can just refer to what kind of method that we would use to be able to organize our ideas, okay? So in this case, right, when we do list out our accounts, there is a particular order how each account operates, okay? And that's going to be having main accounts, sub accounts, and contra accounts, okay? Now the main account is going to be very general, okay? For instance, okay, we have the main account called inventory, right? That, in this case, right, inventory is just going to flow in a specific direction, Okay? What does that mean? Well, when we get to the accounting model, it will make more sense. But in this kind of context, right, when we understand what the main account under the category, right, of the account type here, assets, right, that means anything that's a main account is going to flow in a specific direction. Debits usually influence our assets. Okay? Now, the main account is such a broad description of an asset, right? Even though, yeah, inventory is just going to just generalize everything that you are going to be selling, right? This is the products that you're going to be selling. How can I make my account even more specific? I can create a sub account which gives the main account more information, okay? And it usually flows in the same direction as the main account. So for instance, my inventory, right? What products can I sell and be specific about it? In this case, I can sell coffee mugs as part of my inventory. So that's an example of a main account and a sub account, okay? Now the third account I have is called a contra account. A contra account can either give more information to a main account or a sub account. Okay, so whether it is accounts receivable or it could be inventory. Okay, now what does a contra account do? In this case, it does give the main account or sub account more details, but the key word here is contra, right? We know in English, contra means opposite, right? So in this case, that's exactly what this account does, is that it flows in the opposite direction as the main account and the sub account. Okay? So if, for example, right, if my assets usually are influenced by debits, then I can say a contra account is going to have a credit influence, right? Because credits will flow in the opposite direction as my main account. Excuse me. I'm so sorry, guys. I have to pause the class for a minute. Okay. Okay, so this is where we last left off. Okay. So in this case, right, the main account basically gives the account type some detail, right? So in this case, an example of an asset would be cash, accounts receivable, inventory, right? Those are very basic general accounts, right? Cash could be anything. Cash in the register, cash in a lockbox, cash on hand, cash in the bank, right? So if you do want to expand that, you can create a sub account which expands or gives more detail to the main account by giving it more detail. So for example, inventory, right? I could say I sell coffee mugs. And then of course we have contra accounts, which does similar aspects because it does give the main account or the sub account more detail. However, the only difference is it flows in the opposite direction. Okay, so if you remember my example, I did say if an asset is usually increased by a debit, then creating a contra account would be to would basically have a credit flow to increase the the purpose of a contra account is to decrease the main or sub account. Okay, it's because it flows in the opposite direction. So in this case, that's the example here, accounts receivable and the allowance for doubtful accounts. I will talk to you guys more in depth what these accounts are in, I believe in the end of this chapter, we do a little quick example. But at the end of the day, we need to understand that this is usually how you organize your account types even further by creating accounts that represent whatever you need to represent with these associated account types. Okay? So next thing we're going to talk about is going to be debits versus credits. Okay, now you have been hearing me mention what a debit and what a credit is. Now in this case, right, I did mention saying that debits can increase a specific account. All right, and that is true. When we get to the accounting model, it will make a lot more sense what I am talking about. But for this class, you do need to understand that debit and credit is going to be referred to as left and right, okay? Because in this case, when we do talk about the accounting model, we're going to take a look at a debit and how it is going to influence a specific account type. So again, debits doesn't always mean increase, okay? It can be used as decreasing as well, okay? So that's why I don't ever want you guys to refer debits and credits as increase and decrease. No, because you have to look at the context of which account you are looking at. Because a credit can increase an account, not decrease it, okay? But if you are looking at an overall just one account only, for example, your checking account, right? If you add money to it, you're debiting your account. But if you are spending money from your bank account, then you're going to credit your account. So how we should actually really understand debits and credits is that, yes, in context, they do increase and decrease a specific account. And how we should look at it is looking at it as if it is on a number line, okay? Right in the middle is 0, okay? Debits can increase by number. Credits can also decrease by number as well, okay? But those are in context of a specific account type. So that example I said right there was checking, right? If I debited my account, right, if I added money into my checking account, let's say I added $3, I'm going to move to the left. Now, if I spend those $3, right, then I'm going to be moving to the right 3 and I end up back at 0. So that's why it's so important that you're going to have to understand that debits and credits is like using a number line, okay? Where every step that you take, whether it's to the left or to the right, debit or credit, right, they have a certain number to them. And it's not negative or positive, right? It's in terms of how many you're going to go left versus how many you're going to go to the right. So like I've said, checking account is a great example of I'm adding $3 to my bank account and I take that $3 and I spend it, right? So then I'm back down at 0, okay? And that's how we talk about debits and credits moving from left to right. And that's why it's important for you to understand debits are usually referred as going left and credits are usually referred as going right. Okay? Right? And of course, we also talked very briefly about the accounting equation. Your assets is going to equal your liabilities plus your equity, okay? So once again, this is the fundamental backbone of a true business, right? Of any business, actually, okay? In this case, right, assets are going to be everything that we own, and it must be equivalent to everything that we owe plus the value of my company, okay? Now, in this case, it doesn't matter where you are in your accounting period. This equation must hold true at all times, okay? If for any reason it is imbalanced, then you have either done something incorrectly into your journal, into your ledger, or just accounting through the process of accounting, you recorded something wrong, okay? So that's why it's very crucial that you do test this accounting equation as often as possible, right? Because this accounting equation is going to ensure that your books are always balanced, right? Because of this equal sign. you need for them to always be equal to each other. Okay. But again, we actually will get to see and how to test the accounting equation more so towards the end of the accounting period, right? Which is towards the end of the class, because there is that one financial worksheet that actually tests this, right? The balance sheet, okay? Which is going to be testing the accounting equation. Okay? So let's actually break down each account because each account has its own separate categories, okay? So, for instance, okay, assets, right? We talked about what assets are. It's everything and anything that you own, you have ownership over, okay? So, a great way to categorize it is going to be based on liquidity, meaning how easily is it going to be converted into cash, okay? And that's how you're going to list them, all of your accounts. You're going to list them in a particular order because we want to make sure that when we list our list out, we want to see which one can be easily liquidated into cash. So in case for any reason that we need a quick turnover, right, we can get cash instantly, right? But in this case, when we're listing out our list on our chart of accounts, which we'll talk about in chapter 3, in this case, I'm going to list it based on a category. So I'm going to further categorize it under each asset type under these 3 categories, okay? First one you have here is your current assets, okay? Your fixed assets and your other assets, okay? So if we're looking in terms of liquidity, right? Your current assets are going to be the ones that you can convert into cash and be able to do a quick turnover within the year that you're operating, okay? So a great example will be cash. Obviously, cash is in its liquid form already, but inventory, right? Inventory, all you have to do is just sell your product and boom, you got cash, okay? Now, the second one is going to be called fixed assets. Your fixed assets, also known as PP&E, which represents property, plant, and equipment. And if you refer it to PP&E, right, this will help you the most to understand the difference between a current asset and a fixed asset, okay? Because property is going to be anything that you own. For instance, land. Land is property, right? Your sidewalks, your streets, your parking lots, those are going to be all things that are part of your property, okay? The plant is going to be the building and everything inside the building, okay? So you got the building is the plant, right? Inside the building, you got tables, you got chairs, you got lights, okay? You have refrigerators, okay? I don't know. So that's the example there. And then the last one is going to be equipment. Equipment's going to be anything that helps you operate, so machinery. So a refrigerator would be an equipment, right? A toaster, an oven, okay? Those are going to be equipment because it helps you. It's usually electronic or it's like a machine, okay? So that's what an equipment usually is categorized as, is it's some kind of type of machinery, all right? And that's how you understand, okay, if these are items that belong into either the 3 categories, property, plant, or equipment, you're going to immediately associate that to a fixed asset. Now, let's think about it this way, right? Why is a fixed asset going to be under a current asset? Well, let's actually think about it. If you're purchasing a building, okay, or you're purchasing furniture, right? How long is it going to take you to be able to convert that into cash? Okay? Especially a building, you have to go through escrow, You're going to have to go find a real estate agent to be able to put your building on sale. And it's not like then you have to go once you get through escrow. Escrow could be anywhere from a 6 month to a year process, right? Where you're running background checks on the person who is trying to buy your property. That can take anywhere from 6 months to or a year to be able to sell your building. So in this case, is that quickly, easily convertible to cash? No. Same thing with the furniture, right? Especially when you buy things like furniture, right? And you use it. Now, is it possible to get money out of it? Yes, you can. But how long would that take you? Okay, you may have to put it on Facebook marketing, right? Marketplace, right? You then you contact the person who wants to buy your furniture. They have to come and look at it, inspect it, right? And then they're going to have to make a decision whether they want to purchase it. And then you're going to have to figure out how you're going to send the money, how you're going to get the furniture to their location. At the end of the day, it takes a long time because you're not going to sell it within 10 days or the first 10 days, right? It could take really long time because not everybody's going to be looking for that particular furniture. Okay? So in this case, that is why a fixed asset, which is anything that's a property, plant, or equipment, is going to be considered underneath the current assets because it's going to take you a long time to get cash back. It's not going to be easily converted into cash. Okay? And then last one is going to be other assets. So in this kind of category, it's typically anything that's an intangible asset, okay? So for example, right, intellectual property, so copyrights, patents, license, okay? Can you actually touch those items, okay? In that case, no, right? That's why they're intangible, right? You can't really touch them. Because think about it in real life. If you're buying a copyright, right, or if you're buying a patent, which is an invisible security shield over an idea, right, can you physically touch that? You can touch the paper, but that's not what copyrights and patents do. You can't touch that invisible field of that security, right? So that's going to be considered an intangible asset, and normally those kind of things are very hard to sell as well, okay? Especially intellectual property, right? Copyrights, patents, licenses. If you do an agreement, yeah, you can go ahead and get that, but going out of that contract is going to be very difficult. So again, unless you sell it to somebody else, then there you can get your money immediately. But most cases, those kind of intellectual property has a huge value on them. You don't want to sell those things out, right? You want to hold on to them as long as possible. And maybe over time, they will increase in value as soon as it becomes popularized, right? So in that case, it's going to be considered another asset because of the idea that it's intellectual property. It's not going to be easily convertible because it's usually going to be dealing with a legal firm, okay? Because again, they're the ones that's signing up and creating a contract to create this legalized form, and breaching a contract can cause a lot of damage, but it also can take months to get resolved. So at the end of the day, it's not the easiest to get your money out from these legal entities, okay, or these legal binding contracts, okay? So your other assets are going to be your intangible assets. Any questions? Okay. So we move on to liabilities, okay? Your liabilities is going to be anything that you owe to other people, okay? OWE, okay? Meaning you don't have ownership over it. In fact, you borrowed money and now you have to pay it back. You owe it, okay? And we need to further categorize that based on things that are due within a year. Okay, those are going to be called your current liabilities, not short-term liabilities. Okay, do not confuse this, especially with liabilities. There is no such thing as a short-term liability and a long-term liability, right? It's current and long-term. Current is when you owe within a year. So that means a bill that's due in 30 days is going to be considered something that is a current liability. Okay? Typically, anything that is longer than a year, so usually loans, right? Loans are usually minimum of 1 to 36 years, right? If you're talking about property management. A home loan can be extended for 36 years, while a small business loan can range from 1 to 5 years, right? So those things, because you owe them for more than a year, those are going to be considered your long-term liability. So pretty straightforward. So again, example will be sales tax, right? I can guarantee the state's not going to let you hold the money for a whole year without giving them their money, right? So you're going to be collecting sales tax, and usually you submit them either every quarterly, but they do, depending on your business as well. If you are a smaller business, you can get away with giving it a year later, or holding it for a whole year and then submitting it. But it's still within the year, okay? Because you're going to have to file for taxes anyway. So that is sales tax, okay? And of course, interest payable, right? Usually interest is usually, if you have a credit card, it's always paid every single month. So every 30 days, you get charged interest, you pay it. Okay? Now, long-term liabilities, again, are going to be any typical loans, okay? Here's what you have to know. Liabilities are not debt, okay? In context, in the real world, we always refer this as debt, right? You owe somebody, it means you're in debt. In accounting, they're not debt. They're obligations because you decided to borrow money. So that means you are obligated to have to pay them back. That's how you have to understand it. Okay? Any questions here? Okay. Next one is going to be your equity. Now, we did go briefly over what equity does, right? And what equity is. Equity is going to be your net worth, or basically your value of your company. So what comprises of equity? It's usually your income, okay? But things that can increase your equity is going to be anything like a capital contribution or anything like a net income, right? So we talked about the statement of equity, where if you want to and you reinvest the profits back into your company, you're increasing your equity. Things that decrease your equity is going to be an owner's draw, so you take money away from your company, or a net loss. Now, in this case, for this particular type of equity, since we are looking at owner's equity, meaning a sole proprietor, there are no categories for equity, okay? Only if you are in a corporation, yes, you will have categories. But in this case, we're not focusing on corporation, right? We're focusing on the very basics of a small business. So we don't care what a corporate has, right? We care what we have, okay? So in this case, there are no categories for equity, okay? But there's only things that can increase it or decrease it, okay? That's all you need to know. There are no categories. So in equity, the only thing that you will be necessarily looking at is going to be capital contributions, owner's draw, net income, net loss, and income summary, which we talked about is, or not yet, but income summary is also known as your retained earnings. Okay? All of those are going to influence your equity, but there's no necessarily accounts that are going to actually be categorized, because there's only so many options you can do for equity. Okay? So let's talk about income. Where does net income come from? Well, it comes from your operating income or revenues as well as your expenses, right? We said that your revenues minus your expenses is whether you determine if it's positive, you have an income. If it's negative, you have a loss, okay? So that's where this part is going to expand, where your revenues, right, are also going to have categories itself as well, okay? Now, again, revenues or income, right, whichever one you want to refer them as, what it is going to be a means of generating income for your business, whether it's through selling a product or providing a service. Okay? So ultimately, what we're looking at is going to be our main operating revenue, okay, or operating income, right? What is the main core that you're generating income through? And that's going to be, because we're looking at a merchandising, ours is sales, okay? Sales, okay? And we also have other things like other income and non-operating revenues, okay? Other income, right, is going to be straightforward, right? Other income and non-operating income, they're synonymous. It just means how did you generate income that is not from the main core of your operations. Okay? So for example, right, you buy shares from another company, right? And you're using that money to be part of the income for your company, right? So this is where when you merge from another company, or their brother and sister companies, right? They tend to share each other's earnings so they can build the brand even stronger, right? So that's where other income can fall under, because your main core isn't selling your stocks. Your main core isn't distributing dividends. It's to sell a good or service. So that's why those things are going to be considered non-operating or other income. Okay? So that's your income right there. But what about my expenses? Expenses, there are 3 categories, okay? Cost of goods sold, operating expenses, and then you have non-operating expenses, okay? So first one, right, let's talk about what an expense is. Well, an expense is going to be an account that represents you spending money in order to operate your business, okay? So for example, right, you need to pay for rent. You need a building in order for you to open up your store, right? For you to sell your product. You need to pay for advertising to let customers know that you have a product available and it's on sale or whatever it is, right? To bring your customers to your store. Those are things that you're spending money in order to operate your business, right? Now that's the operating section there. What is cost of goods sold? Well, cost of goods sold is directly correlated to your sales as well as your inventory, right? When you sell your inventory, right, you need to find a way to get rid of your inventory. And how would you do that? The cost of goods sold account. Well, how did you get rid of your inventory in the first place? You sold it through your revenues. So that's why they're all connected. So cost of goods sold is a means to represent to get rid of the product that you have in your inventory. Okay? So when we think about expenses, this is how I like to think about expenses is think of it as a way, as a means for you to either use something, spend something, or to get rid of something. Okay? Expense, right? You're spending it, you're getting rid of it. So in this case, that's how I see it is if it's anything that you're spending, okay? Or anything that you're trying to get rid of, or you're attempting to use something, go ahead and categorize it as an expense. Okay. So again, we talked about cost of goods sold, which is directly correlated to inventory and sales, operating expenses, which I already gave you an example, right? You have to spend money in order to operate your business. What about non-operating expenses? Okay. This one, it is a category, but we don't really necessarily see too much of it in a sole proprietor or a small business because not all businesses will have a non-operating expense. Now, I'll give you an example. A non-operating expense is going to be if you have a separate warehouse, okay, that's holding all your inventory, right? And you have to pay some security, some electricity bill, or some kind of, electricity bill to be able to temper the room, okay? That is not your main core of operations because that's a facility that is way separate, right? That has nothing to do with the main core of your operations, right? That isn't you directly selling a product. That is a storage unit that you pay extra to hold the items in inventory. And by you making payments to a security guard to make sure no one steals it, has nothing to do with your main core of operations, right? Your main core of operations isn't to store inventory, it's to sell inventory. So that is going to be considered a non-operating expense because that is something that you're making a payment to, you're spending on something that isn't part of the operating operations of your core business, okay? However, if you want to think of it this way, if you have a store location, that's going to pretty much give you your idea of what your operating expenses are because anything that has to do with that store is your main core of operations. Anything outside of that property, so again, the warehouse could be down the street, that has nothing to do with the location that you're in. So that way you can understand. Then that's a non-operating expense. Okay, all right. But again, we won't see too much of it just because we're starting out. As a small business, not many small businesses is going to have like a warehouse on the side just to hold inventory like that. Okay. Any questions? Yes.
So the way I was reading a note and how you're explaining the income and no the income slash revenue and expenses are part of equity.
Yes.
Okay.
It is because remember, right?
Okay.
Your revenues and your expenses is what creates your net income and your net loss. And
Okay.
net income
Uh-huh.
can increase your equity, but a
Yeah.
net loss can decrease your equity. So, yes, that's why when we did the accounting equation, your
Yeah.
equity is not solely your asset minus your liabilities. It's much more than that.
Would you say last part? What did you say?
Equity is not going to equal your assets minus your liabilities, right? Because that's another way that you can think of the accounting equation.
Yes.
That's not true because equity is much more than that,
Okay.
right? You have
Yeah.
your net income, you have your net loss, you have capital
Yeah.
contributions, you have owner's withdrawal. So it's not just strictly assets minus liabilities. That's why the correct accounting equation is your assets is equal your liabilities plus your equity.
Okay.
Yeah.
And then within the equity, you said that it can have a plus like net income, also the negative like net loss.
What do you mean by class?
Hmm?
You said, can you repeat your question?
Oh, so within the equity, there is it can be plus ingredient like net income, but also the negative. Um,
Oh, yes. These are
neg-
contributing factors that could increase it or decrease it. Yes.
yeah, that's what I mean. Thank you.
So, yes.
Okay.
So, income and expenses are part of their equity if you choose to reinvest into the company or if you did end up taking a loss. Yes, it
Okay.
is a part of equity.
So that's why they wrote the note the way it is. Like,
Mm-hmm.
okay, thank you.
Mm-hmm. Any other questions? Okay, so let's see what the next part is going to be the accounting model. So this is what I was talking about when I said in a specific account type, right? A debit will increase on one side and then a credit will decrease on one side. Where on another type of account, a credit can increase an account while a debit decreases an account. So this is where you have to be very careful on once you figure out and establish what your account is by determining what account type it is, then that's where you can kind of figure out here. This is called a normal balance because typically, right, a normal balance is where a certain account has a tendency to frequently be using a specific debit or credit, right? So for instance, right, an asset would normally be debited, right? Because in this case, it will give me a positive outcome. Okay? So in this case right here, the normal balance is where in each specific account is going to be the side that is positive. Okay? So in this case, a debit, which increases your assets, right, is gonna show is gonna influence it to be more positive, if that makes any sense. Okay, because we look at a number line, right? If we have debits as a positive number, then that is going to determine that your debits is going to increase your assets. Okay, so in other words, your normal balance is going to be whichever side that is increased on, okay, on the positive side. Okay, so but that's only for assets. Where liabilities, a debit decreases it. So that means normally you would typically use a credit to increase a liability. Okay, that's also same thing with our equity, right? Our equity is increased by a credit. So is your revenues. Your revenues is also increased by a credit. However, once we get to expenses, debits increase your expenses. So a good way to memorize this is going to be assets and expenses flow in the same direction while everything else flows in the same direction. Okay? Now, again, I've also posted a copy of this because I don't expect you to memorize this. So this is going to be really, really, really useful when we dive into chapter 3 where we practice journalizing. Okay? So in this case, right, we're looking at how we can use this to understand a business transaction. Okay? So a great example is going to be I am paying off my loan. Okay? Since I'm using my money, which is which is an asset, right? Cash, checking account, it's money that you own, right? That's going to be considered an asset. Where a loan, you borrowed money, right? So that's going to be considered a liability. Now, if I am paying off a loan, I am spending money, so therefore I'm going to decrease it. So I'm going to have a credit account there. However, I am lowering or decreasing my liability. So that means I have to use a debit when I am referring that I'm making a payment to a loan. Okay, so that's just an example, okay, of that. Okay, another example is, what if I had a sale? I sold something, right, which is considered a revenue, right? That's income that I have collected. So in this case, how would I, if I sold something, that means I increased my revenues, right? I increased my income. How do I do that? Well, in this case, we have to refer to a credit because I sold something. Now, of course, what is the other end? How did I get paid? If I sold something, did I get paid with cash? And if so, then I must have increased my cash, which is an asset. So therefore, I will use a debit. Okay? That's how we understand the flow of a transaction, is by using this accounting model. Okay? All right? And this accounting model does show up a lot, especially when we go into QuickBooks, right? How do we truly understand the flow of a transaction? This accounting model is going to be your key to understanding and how you're able to actually start journalizing and bookkeep for an actual business. Okay. Any questions? Okay. No? All right. So let's actually talk about the bookkeeping systems. Okay. There are two bookkeeping systems that exist: single entry and then double entry. Okay. Single entry basically means that when you are recording a transaction, you're only recording it in one account or one specific account. So, for example, right, for those of you who have a manual checkbook, right, usually at the top of your manual checkbook will give you a little mini ledger, right, where you can record, I wrote a check, right, so you can keep a balance in your checkbook, right? So that is only an example where you write that check, you record it at the top of that register, and you're done, okay? That's an example because what you're only doing here is you're only ensuring that you took money out of your checking account because you wrote the check. That's the only account that you're looking at, is you just only took money out because you wrote a check. Okay? Now, in a double entry system, this is where we record that same exact transaction, right? But we record it in one or more than two places. Okay, two or more places is what I meant. Okay, what do you mean by that? Now, in this case, right, this is where I have wrote a check, but why did I write that check? In this case, I wrote that check out maybe to pay rent. So therefore, I'm influencing another account, rent. I paid money for rent, so therefore I must have increased my rent expense. Okay? So if that's the case, then you have recorded a double entry, right? You recorded that you spent money in your checking account, and you recorded that you purchased or you paid for rent. That is two or more accounts that you have recorded, okay? So this is where applied science is going to come into play, right? Because for every action, there is an equal and opposite reaction, right? I spent money because I paid for rent. So that's the idea of double entry, is that you're going to have to keep this kind of system, especially with accounting, because this is where your debits will always be equal to your credits, which is a number one rule, especially when journalizing, is your debits must equal your credits because you're using the double entry system, okay? we dive into QuickBooks, that's where we actually take a look at a single entry, right? Because for us, when we enter in the transaction, we're only entering in one account because, for example, right, if I sold something, all I do is just enter in a sales receipt. That's only one place that you're entering that in. You're just recording that I made a sale. However, QuickBooks will do the accounting behind you, and it will either increase your checking account and it will increase your sales and whatever other accounts that are tied to that sales. Okay? So, but in this case, right, there are two accounting systems that exist for this class. You need to know we will be using the double entry system, especially when we dive into chapter 3 when we talk about journalizing. Okay? So keep this rule in mind that your debits will always must equal to your total credits. Okay? And that is the double entry system. All right, course review, right? We talked about what accounting is. We talked about the accounting equation. We talked about the accounting model, okay? We talked about the debits versus credits and the normal balance. And we even talked about each and every single account with their respective account categories, okay? And again, we know that our permanent accounts are going to be these three accounts, while our temporary accounts are going to be your income and your expenses. Okay. Any questions in regards to chapter 2? All right, no questions, then we can go ahead and dive right into the chapter 2 exercises. Okay. Number 1, okay, what are the 5 types of accounts? Yes.
Assets, liabilities, equity, revenues, and expenses.
Good. Okay. All right, what is a main account?
Main account is an account that makes up a list in certain type of account.
Okay, main accounts. You said make up a list.
In a certain type of account.
Okay, and what typically does a main account do in regards to debits and credits?
Um, it's mainly used to hold cash, but it also uses accounts receivable.
All right, not what I was looking for, but in terms of flowing, what does a main account usually flow? It flows in a specific direction, right?
It flows in debit, right?
That will depend on the account that you're looking at. Not everything flows in the debit side. So that's where the accounting model, right? Your liabilities do not flow in the debit side. So in this case, they typically flow in a specific direction. Okay, meaning if it's an asset, they typically flow on the left side. Okay, if it's a liability, they typically flow on the right side. Okay, that's what I mean here. What is a contra account? Yes.
It gives the main account more detail. The debits and credits flow in the opposite direction as the main account.
Good. And flows in opposite direction as the main or sub account, right? You can also have a contra account be part of a sub account. right. What does left mean? Yes.
So the question 2 and 3, you're simply saying if the main account flow in one way, the contra account flow the other way.
Yes.
Okay.
Yes.
That left means debit.
Excellent, right? And of course, what does right mean?
Credit.
Good. All right. What is the accounting equation? Yes. You can just answer the question.
Okay, the accounting equation asset equals liabilities and equity.
Excellent. Liabilities plus equity. All right. Number 7, what are the 3 categories of assets?
Current, fixed, and other.
Good. Number 8, what are the 2 categories of liabilities?
Current and long term.
Yeah. No short term or long term, guys. Okay. It's just current and long term. Excellent. Number 9, trick question. What is the categories of equity?
Equities not have categories as subaccounts.
Yes, good. None. They do not have any categories, right? They just only have main and sub accounts. Good. All right. Number 10. What is the categories of expenses?
Cost of goods sold, operating expenses, and non-operating expenses.
Good. COGS for short for cost of goods sold. Okay. And then you got your operating and your non operating. Number 11. Okay. What are the categories of revenues?
Sales and the other income.
Good. Sales or other income. Okay. Also known as non operating or operating. Whichever way you want to look at it, they're all the same. Okay. And then number 12. What are the 2 accounting systems?
Single and double entry.
Good. Single entry and double entry. And then number 13. What is the normal balance?
A positive balance found in any specific account.
Okay. It could also be the side which increases on in a specific account. Okay, actually, no, that's fine. Increases. Okay, good. All right, for this section here, is going to be examples of accounts. And what we're going to do here is we are going to figure out what the account type is. We're going to figure out what the category belongs to and what kind of normal balance these accounts should typically have. Okay, so again, this is where your accounting model is going to come into play. Okay, so again, here I list out what are the account types, right? We already talked about them. There's 5 of them, right? Assets, liabilities, equity, revenues, and expenses. And then here are the different types of categories. Obviously, we just went over every single category for each type of asset. So in this case, our job is to take a look at this account, right? I'll give you an account description, and your job is to figure out the account type, categorize it, and Tell me, what is the normal balance? So is it a debit balance or is it normally a credit balance for this exercise, okay? Starting with the very first one is going to be your checking, okay? Checking is going to be money in the bank. So your checking account.
Isn't that asset?
It is an asset. What kind of asset?
Current asset.
Current asset, right? Because cash is already in its liquid form, right? Okay, so then if this is a current asset, okay, so I'm going to use abbreviations. Current asset. Go ahead.
So the normal balance is debit?
Yes, because in this case, if you look at your accounting model, how do you increase an asset? You typically would do that with a debit. So that's how we use the accounting model, because the definition of a normal balance is the side which it increases on the positive, right, for a specific account. So in this case, debits increase your assets. Okay. Okay, second one, accounts payable, money that you owe to vendors.
So liability?
Yes, it is, because you owe money, right? What kind of liability would you?
It's also current.
Yes, typically, if you owe money to vendors, they usually give that 96, was it 30, 60, 90-day rule, okay? Depending on who that vendor is, right? If they're somebody that you work with for a long time, they can let you keep it as long as for 30 months, or don't give them, or don't have them pay you back by 30 months, by 90 days. But sometimes you can go for 6 months, okay? It just depends on who the vendor is, but typically it's usually 30 days. Okay, good. So it is going to be within a year. So typically those are going to be a current liability. Now, how would you increase liabilities?
Credit.
Yes, good. Okay. All right. What about copyrights, which is going to be a legal documentation of ownership or right? Okay.
Isn't that the intangible asset?
It is an intangible asset, so it is an asset. But where do we categorize intangible assets?
Didn't you say other?
Yes, they fall under other assets. Good. Now, how would you increase?
Because each asset is also debit.
Yes, right? Now you're starting to pick up, oh, okay, well, if it's an asset, it's just going to be debited, right? What about supplies? Okay, supplies that are needed to operate the business. Okay, this one can be a tricky one. Supplies. Supplies.
Could it be part of like office supplies?
It could be office supplies, business supplies. It could be just regular supplies.
So wouldn't it be EXP and what else? Hmm.
So, yes, it can be. But in context of a small business, when you buy supplies,
So it comes and goes, so it's current.
it's current, but what
Oh,
type?
asset.
Yes, because once you buy the supplies, who owns it?
We do.
We do. And that's why it just depends on how you see it. If this supply is going to be something that you're going to use immediately, then yes, you can refer this as an expense, right? Because you're going to use it immediately. But what if these are supplies that you're going to keep in your shelf and you're going to slowly use them? Then you own those supplies at that point. Okay? But in this case, when we talk into supplies expense, that is where we use that account to represent that we end up using those supplies that we previously owned. So in this context, we're going to refer to supplies as something that we own. And you said it, it's going to be current. Now, how would you?
So it's asset, so it's debit.
Good, right? You would increase it with a debit. Okay. What about loans, right? Owing money to a bank for over a period of time.
That's a liability, isn't
Yeah.
it?
Yes, it is. Now, what kind of liability typical loans usually are?
Longer term.
They are long term, okay? Unless it's specified as a short term loan, right? 6-month loan. Then it's going to be a current asset. A current liability. But in this case, typically loans, usually you owe somebody for over a year, or at least over a year. Okay? And how would you increase a liability?
Credit.
Mm-hmm. Mm-hmm. Okay. What about an accounts receivable where customers owing the business money? Okay.
Is that a asset?
It is an asset because in this case, right, you end up selling a product to a customer, right? But they said, I will give you an IOU. I promise to pay you back. So at that point, it's almost an IOU is almost as if you had money, right? And you can redeem your money at any time, right? You just mail your customer saying, I want to be paid now. Okay? So that is an instance where this is going to be an asset. Now, what kind of asset?
Current.
Yes, because again, you want your money, you just bill them and tell them you have 15 days to pay me back. And the customer it has to agree. Okay? So in this case, what kind of normal balance would an account receivable have?
Debit.
Yes. Okay. All right. What about owner's withdrawal? Taking money out of the business.
So is that the question I was asking? Isn't that part of equity?
That is part of equity because it is a main account under equity. Actually, to be more specific, this is a contra account to equity. Okay? So it is an equity. Okay? Because how does a owner's withdrawal affect equity? You're taking money out from the business. So how would that affect equity?
Right away. So it's current.
Okay, not current. Do equities have accounts? Categories?
No.
No, they don't. Okay, because this is a contra account. Now, if it's a
Also.
contra account,
Mhm.
how does that affect equity?
So equity usually credit its balance by goes debit then?
Yes, because you're decreasing, right? Are you increasing the value of your business or you're decreasing the value of your business?
We are reducing the
We are because we're taking money away, right? So we are intentionally decreasing our equity. So in this case, if you look at your accounting model, how do you decrease an equity account? With a debit. Okay, good. All right. Next one is advertising expense, basically marketing for the business.
it is an expense.
Yes, it is, right? Now, what kind of expense?
Current.
Not every account has current.
How the Operating expenses.
Operating expenses. Good. So again, if you need help, use your PowerPoint to give you a reference because that's going to give you this right here where you have the asset, you have the categories underneath it, okay? You just don't have the normal balance because you need your accounting model for that, which you could just simply go to the previous slide, okay? All right, good. So it is operating because you need to have you need marketing materials to sell your product, right? Okay, and how do you increase expenses?
It said debit.
Yes. Okay. All right. Couple more here. Okay. Next one is going to be inventory, right? Items that you purchase and then you plan to sell.
Is that asset?
Oh, hold on, I skipped one. Cost of goods sold. But yes, that is an asset. Cost of goods sold, right, is going to be literally the cost of the items that you sell.
According to the note, it said equity.
Equity?
Oh, wait, no, it said expense.
Yes, it's part of expenses, right? Because we're getting rid of our inventory, right? By telling me how much it cost me, right? So what category would the cost of goods sold be under?
All I can tell is it's a contract out.
No, it's not.
It's not?
No, it's not. So let's take a look at expenses. What are the categories of expenses?
Cost of goods sold or operating expenses.
Okay, so then what would cost of goods sold fall under?
Cost of goods sold.
Cost of goods sold. So this one's kind of straightforward just because in this case it's its own category. Okay, cost of goods sold. Okay. And how would you increase expenses?
By debit.
Yes. Okay. All right. Now going back to inventory, right? Items that you purchase that you plan on selling. So we got asset. Okay. What kind of asset would an inventory item be considered?
Well, because we want to get rid of them quicker, so it's current.
Sure. Good, right? Because we're planning to sell them, right? So we're converting them into cash instantly, or try to. Okay. So good. Now, what is the normal balance for an asset, for a current asset? How do you increase assets? Go ahead.
Oh, so all assets are always debit?
Most cases, right? You just have to make sure
it's not contra.
It's not a contra asset account. Yes. Good. Right. What about land, which is property?
Wouldn't that be considered an asset?
Yes. What kind of asset?
I'd say current or operating because you're currently living in it.
So it won't be operating for sure. That's not a category. Now, current. So we talked about this, right? Can you convert your land into cash
No,
easily?
so not really because you have to go through a lot of little like hoops and stuff to even
Yes.
be able to sell it. So it'd be fixed then, huh?
It'd be fixed because it's part of the PP&E. You remember PP&E, property, plant, or equipment? This is property right here. So it's going to be automatically a fixed asset. Good. How would you increase a fixed asset if you purchase land?
Mm, debit because you'd be able to. I mean, use cash to build stuff on it.
Excellent. Okay. Next one is going to be sales, right? You earned money through selling a product or service.
That'd be debit because cash, and it'd be R for revenue because you're getting a sub.
Okay. You got the cash part correct, but I'm not looking at cash. I'm looking at sales.
So then it would be
You said R for revenues. That's correct. So it is a revenue.
mm, income.
Yes, it's income, right? Now, what category would you have sales fall under? What
Current.
is not current?
Uh,
Think about it. What is your main core of generating income?
We sold something.
That's sales,
So
right?
cost of goods sold.
Not okay, that's an expense.
Okay.
Okay? We're just right now we're on revenues. I
other
earned,
income. Other income.
not other income, because sales, right, would technically be a main core of my operations, right? That's my main goal is to generate income
Oh, it's
through
gonna be fixed.
sales.
You're always gonna be able to. You're always gonna get sales. And I mean, not always gonna get sales, but it's fixed because you're actually I don't know.
It's not going to be fixed either. So let's take a look at the categories of sales, or in this case, categories of um, income or revenues. Okay. So we have operating income, we have other income, and non operating income, right? Now, in this case, sales, right? Where would you put that in between these three? Or where would you categorize that under? Is sales something that you generate?
Yeah, but wouldn't you categorize that income, right?
Yes, it is. It is income.
But it would be operating income, right?
It'd be
Because
operating income because that's your main core of operations. That's what you are generating the income for is through sales, right? Where other income, right? I gave you the example, right? Where if you own shares from a brother or sister company, right? And you're using that to increase your income, right? That's not your main core of operations because your goal is to try to sell your products and services, to not to earn money off of a share. Make sense? Because in this type of business that we're looking at, our main core of operations or our business activity is merchandising. We are acting as if we are a retail person where we're buying products and our goal is to sell the product. Okay, so that would be considered our main core of operations, and that is where we're generating our income through operating income. So in this case, it's also referred to as just sales because we're looking at merchandising. Okay, our business is not making money through dividends from a third party company. Okay, that's not our main core of operations. So in this case, that would be operating income, or in this case, I believe the categories that we placed here is sales. Okay? And how do we increase our sales?
uh, debit, right? No, it would be credited because you don't you like in a business don't you not get the wait
No, no,
debit.
No. You were right. It is credit. Okay, good, right? So in this case, right, let's take a look, right? How do I increase my sales? Okay, so let's take a look. Revenues, right? Now, debits would decrease my sales, but a credit would increase it, right? This makes more sense when we dive into chapter 3, when we actually initiate the journalizing process, right? Because that's going to help us understand why we use these accounts in a specific way. How are we looking at a business transaction and being able to put it on a piece of paper and be able to categorize it based on using your debit and credit system, okay? So in this case, that's for now. We just have to understand that credits increase our revenues. Okay. All right, a couple more, guys. Okay, so we have capital contributions, which is investing money for the business.
Investing money for the business, wouldn't that be um no, it wouldn't be current with it. It'd be revenues because you're investing money into the business, so your business is gaining money.
Okay, now revenues is when we generate money, where we make the money. Now, in this case, I'm not making the money. I'm taking a lump sum of money that I already have and I'm putting into the business.
So owner's equity?
Owner's equity. Good. It's equity. Okay? Now, what are the categories of equity?
Um,
There's none.
Excellent. So, how would a capital contribution affect my equity? Am I increasing my equity or am I decreasing it?
well, you're increasing it, so it'd be credit because you're not losing any money from investing.
Good. You're intentionally increasing the value of your company. Good. All right. What about equipment? Okay. Any machinery or object to run operations.
It's an asset because we own it,
Mm-hmm.
and it's fixed.
It is fixed because it belongs in the PP&E, right? Property, plant, and equipment. Excellent. Okay. And last but not least, what kind of normal balance would this normally have?
I say it's usually debit.
Yes, right. If you purchase a machinery, you are increasing it with a debit. Okay. What about notes payable, right? IOUs to other people. IOUs to other people. Okay? So you are making IOUs to other people. Yes.
Would that be liabilities?
Yes, it would, because you are owing other people. Now, here's this terminology, an IOU. Okay? Now, in this context, right? Oh, sorry, it's a liability. In this context, right? What can you do with an IOU? An IOU is terms, right, that are negotiable.
Oh, so wouldn't that be it'd be other income because I mean no, not other income. It'd be current.
It can be current, right? Because let's say my IOU says, I'll pay you back. I promise to pay you back in 6 months, right? But you can also have the capability to renegotiate, saying, I'm so sorry. Can I extend it for another 6 months?
So
Can
it'd be
I
long
defer my
term.
payment for a year or two?
So it'd be long term because you
It
could extend it if you want.
It can be, right? Depending on what the terms are, right? If it's a 6 months term, then it's 6 months. But if you choose to renegotiate and say, hey, can I defer my payment for 2 years or another year, then it becomes a current, becomes a long term because now you're owing for more than a year. So in this
So
case, it can be both long term or current. Okay? And how would you increase this?
credit.
Credit. Good. All right. Let's see what's next. We have rent expense.
It's an operating expense.
Good, right? Operating expense, right? Because you need to have a location in order for you to sell your product, right? An actual store. Okay. So in this case, rent expense.
Debit.
Yes. Excellent. Okay. All right, two more. Okay, what about delivery income? Okay, when you charge your customers to cover for delivery.
Delivery income, wouldn't that just be under the category of current? Because yeah, wouldn't it be current?
Not current, because I don't know what account type you're referring to.
I mean, oh, I meant I'm sorry, I apologize. It would be an asset because you can't or a liability.
Okay, so you're charging customers to deliver an inventory
Expense.
item. You're charging.
Oh, you're charging them, so that'd be revenue.
Yes, good, good, good. You got a revenue, is correct. Now, here's the question. Is your business to sell the inventory or to ship the inventory?
Well, it'd be to well, if we're doing delivery income, then it'd be my job to deliver it.
Yes, but at the end of the day, is your job primarily
No,
to
it's to
deliver?
sell it.
It's to sell it. So in this case, where would you categorize this instead?
I categorize that in just cost of goods and
Not cost of goods sold. So let's take a look at our income real quick. So you have operating income, you have other income, or non-operating income.
wouldn't it just be non-operating then?
It would
Because
be non-operating because in this case, right, you're in the business to sell the inventory. Unless your business is part delivery, then of course it's going to be considered part of your income. But in this case, your goal isn't to deliver. Your goal is to sell a product. So in this case, this would be considered generating income other than selling your product, okay? So in this case, it's the other income or other or non-operating, like we said, right? Now, how would you how would you
debit, because I mean they're paying for you to deliver it, so you begin. Wait, it'd be credit because revenues. Credit increases revenues.
correct? Good. Okay, so yeah, so I understand. See, now you're getting very, very confused because you're only seeing one aspect. I just charge my customers delivery income. That means I received money. That's the other side of the double entry, right? You need to recognize what the transaction has happened. I charge my customer for the delivery charge. So in this case, I increased my income. How did they pay me? Then that's where you say I increased my cash flow because they paid me with cash. So that's the double system entry, is that you're only looking at the other side of the equation of the equation in this case, right? You're not looking at
Gotcha.
the whole picture. So good. So good. So it is a revenue and it is operating income, or whatever you want to say, non-operating. Last but not least, purchase expense, where you're making purchases for the business, operations, or inventory items.
That would be that'd be what you call it, expenses because you're spending money to operate it.
Excellent. And
It would be cost of goods sold, right?
not cost of goods sold,
Oh, I mean it would be purchase expenses.
because you're not selling the inventory items directly, you're making a purchase for them.
So current
Not current.
or operating because it's the cost of operating. You gotta buy your things.
Excellent, right? Good. It's the cost of the business, right? You need to buy the items or buy the inventory in order for you to sell it. So good.
Debit because debit increases with expenses.
Excellent. Good. All right. So let's take a brief minute to just go ahead and review this. Now, again, this is just typical accounts that you will see throughout the rest of this course. Now, in this case, how is it possible that we are able to look at these accounts and be able to determine the account type, a category, and normal balance, right? Yes. If you didn't have the context right here, where you have the description of each and every single account, then it's going to be definitely difficult to tell, right? Here's a trick for you guys, right? Most liabilities are going to have the word payable behind it, okay? So, for example, notes payable, accounts payable, sales tax payable. You're going to have the word payable in there, and that's going to indicate that it's a liability, okay? Your expenses are kind of straightforward too, right? You're going to have the word expense at the end of every single account. Supplies expense, advertising expense, rent expense, okay? Those are going to be your typical expenses because it's straightforward. It will have the word expense in it. Now, as far as assets, that's going to be kind of a difficult one just because you just have to take a look at the account and figure out, do you own it or do you not own it? Okay, so for instance, right, land, do I own it? Yes, I do. Then that becomes an asset, right? Because what else would you do with land? Can you owe land? Can land be part of your equity? Is land considered the value of your company?
I mean, not necessarily because land is just. I mean, land is what you need to be on it. It doesn't necessarily have to do with your company.
Exactly. So that's why I'm justifying that land, right, is what you own, right? It's not, you're not generating income off of the land, and you're not going to spend the land to make money. So in this case, that's what I'm trying to say is like take a look at the account and make a decision. Do you own it or do you not own it? Now in this case, land, of course, you own it. Right? It'd be no other category or no other account type would make sense for land. Right? Same thing with inventory, right? Inventory. Can you owe inventory? That makes no sense, right? Can you generate income with inventory? Yes, you can, but how do we do that? Through sales. So that has nothing to do with inventory. Okay? So that's just a little way to help you guys out here. So Right now, it is exactly 3:15. We are kind of running a little behind, so I'll go ahead and let you take your 15-minute break. So please be back no later than 3:30, and we'll go ahead and continue on